We love dividend increases on this channel. We're going to talk about 6 recent ones that have happened. In fact, the first one today, Walt Disney Company, an 11% increase just yesterday. The one prior to this last year was around 50%. Although one thing we do need to let you know, as we can see from the graph, they had in fact cut it only to restart it a few years ago. Now each one of these companies, will have a very brief look at them and also discuss our own valuation. With the Walt Disney Company, we get a double buy signal from both Seeking Alpha as well as Wall Street, and whilst we do get a hold from Quant, 3.47 isn't far off the 3.5 that would flip them into a buy. We also notice their yield does sit around 0.77% and they do trade lower than the S&P on a forward basis around 21.55, up around 26% over the last 12 months. If you've been a longer term shareholder, you would be up only 27%, a bit of a roller coaster after the last 10 years, and we can see their all-time highs, in fact March 2021 at just under $200. Right now it isn't far off half of that value. When we look at their next 4 quarters, management do expect growth to the EPS, and we always like to see green right across the board. The last 4 quarters indicating to us management outperforms 100% historical forecasting accuracy. September 2026, their next full year accounting, they expect the earnings per share to increase, there in turn lowering the forward P to 19.27. As we said, very brief for each one of these companies, we are going to jump into their valuation as well to give our own perspective on where they sit in the under or over valuation category. Walt Disney, our intrinsic value, $140. Now we'll show you just for this company, but we don't want to get into too much of the inputs and outputs today. As we said, very brief. We have the free cash flow year on year. Average growth at 57% over the last 10 years. Now they are expecting to grow their free cash flows rapidly over the shorter term at least, and we've gone for 11%. That is lower than management estimates. With a discount rate at 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, that is how we got to the $140, which is actually not far off where Wall Street see this over the next year. They have a $138 price target, which means 19% upside from today's value. And don't forget, on this channel, we always apply a margin of safety, 10% minimum, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy today at $126, and we keep going till it's near the current trading price. Now, not at the 20% level yet. So for Walt Disney Company, 15 to 20% MOS, with Wall Street, as we can see, 19% upside projected over the next year. Do give us your thoughts whether you believe these companies are buy, holds or sell. We then move on to the Dividend Company, where again, just over the last few days, they have increased their dividends at a double-digit rate at 10%. Over both the last 5 years and the last 20 years, we do see continuity in that. In fact, 13% year on year on average over the last 20, and they have been increasing those dividends for the last 4 years, although they've been paying one to shareholders for the last 31 without a reduction. Now, in terms of where they sit, right now they are trading right there towards the upper end of the 52-week range. We only get one buy rating, that is from Wall Street. Both Seeking Alpha and Quant give this a hold. In terms of the forward yield, well, 1.3%. Forward P, 23, marginally lower than the S&P. Over the last 12 months, it is up around 23%. Over the last 10 years, if you have been a longer term shareholder, that is a massive outperformance of the S&P 500. Now bear in mind, this is a cyclical industry. That is noted as well through the projections over the next 4 quarters. 3 of the next 4 quarters, they are expecting a decrease to the earnings per share, but we do get to see some very positive news with a 100% historical forecasting accuracy from management. EPS is still expected to increase over the next full year accounting, which in turn will lower the forward P just over 20. Now, in terms of the valuation, our intrinsic value just under $470, and again, similar to Wall Street, their price target $470. They only believe there to be 3%, so very minimal upside. And when we do run it through the MOS calculation, right now, Deere & Company, we do not get a 10% margin of safety, at the 5%, it is still not there. So right now, we do see this company trading right near its intrinsic value. We also want to let you know we have released our latest free weekly article where we run through 2 cheap stocks that have gone under the radar. Now, we drop one every single Monday morning into your inbox where we cover severely undervalued stocks that we believe deserve your attention, as well as what's gone on in the market over the last few days. So click below, you can sign up, start reading straight away. You'll also gain access to 28 undervalued dividend stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 29 dividend stocks with the most upside in the S&P 500 right now according to Wall Street. So as we said, click below, you can sign up and read straight away. We then move on to Hormel Foods with a dividend increase just a few weeks ago. Now 2.7%, that is below the inflationary target we like to see at 4%. In terms of the performance over the last 5 years, a lot better. In fact, it was double digits over the last 20 years on average. We do also note they are a dividend king with 50 plus years of consecutive increases. Always great to see, just a little bit disappointing though with that increase. We get a triple hold right across the board from all 3 analysts. It is trading around the midpoint of the 52-week range, probably one of the most attractive yields today at 3.63%, a forward P sitting at 19.1. Now over the last year, it is up only around 4%. In fact, the majority has just come from today where it is up more than 2%. Over the last 10 years though, not the greatest performance, up around 28.26. Bear in mind though, if you reinvest your dividends, it would be up slightly higher. Where do they see themselves? Well, over the next 4 quarters, 3 of them to be growth, and when we do look back, at a bare minimum, they have been in line, so that is always good to see. Growth anticipated, 184 October 2026, there in turn lowering the forward P to 17.37. Our intrinsic value at $36. Remember, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Hormel Foods or any others. At $36, we do get a margin of safety today, pretty much around the 10% point, although we do notice Wall Street see the 12-month target at $33, indicating very, very minimal upside. Do give us your thoughts. We then move on to Merck & Co. with a 5.2% increase in November, so just above the inflationary rate. Over the last 5 years, it has been a lot more attractive at the high single digit at around 9%, but we can see over the last 20 years, at a bare minimum, they have been increasing in line with inflation. Now, they've only been increasing those dividends for the last 12 years, but we can see they've been paying a dividend for the last 53 without a reduction. Now we get a double buy signal, hold from quant. This one is trading towards the 52-week lows, an attractive yield 3.2%, a forward P that looks very low at 13.1, and over the last year it is down 3%. Over the last 10 years, if you've been a shareholder, you'd be up around 79%. Moving forwards, we'd like to see this growth every single quarter over the next year, and at a bare minimum being in line with a nice jump to the December 2025 EPS, 9.46 per share, lowering the forward P to 10.71. Now our valuation for Merck & Co today does signify a very large margin of safety as we keep going till it's near the current trading price. You're not at the 25% level yet. In fact, up to $106, you're getting a nice 20%, whilst Wall Street, very bullish on this company. Their price target, pretty much around our intrinsic value. They see this company hitting 30% over the next year, $135. We then move on to Nike with an 8.1% increase just last week, and we can see over both the last 5 and the last 20 years, they have been increasing it at the double-digit rate. Very nice dividend growth company. Now we get to see 22 years of consecutive increases, meaning 3 more they will gain dividend aristocrat status, and they've been paying a dividend for the last 40 years without a reduction. Now we get just 1 buy rating today from Wall Street, similar to the previous company, Merck & Co, trading towards its 52-week lows, a forward yield above the 2% level, a forward P at around 28.5. Now over the last 12 months, they have really struggled, as we've noticed from our earnings analysis, down 32%. over the last 10 years, up around 64. In fact, quite some time ago, we're talking more than 3 years now, they were trading at their all-time highs of $178. As we can see, their projections showing the tough environment they're in. The next 3, they're anticipating double-digit decrease to the earnings per share, but they have had some very sizable beats over the last 4 quarters. May 2026, earnings per share expected to rise, there in turn lowering the forward P to 24.49. When we get to our valuation, $99 is where we see this intrinsically valued. At 10%, buy at $88. At 20%, pretty much at the current trading price. So 20% MOS, 18% upside from Wall Street. Is this one you have been buying? It is one we have seen in the recent quarter that is part of Bill Ackman's holdings, but as always, do give us your own thought. We then move on to Aflac with a very sizable increase at 16% just over the last few days, but that isn't abnormal for this company. 10% increase over the last 5, 13% on average year on year over the last 20. And they're a dividend aristocrat, 41 years of consecutively increasing those dividends, around 9 years away from becoming a dividend king. Then when we take a look at the actual numbers of this company, just one buy rating, although this time not from Wall Street, it is seeking alpha, trading towards the upper end of the 52-week range, a yield at around 2.2%, a forward P just below 15. Now over the last 12 months, it is down around 25%. Over the last 10 years, though, you would have still massively outperformed the S&P up 266. Now, out of the next 4 quarters, they're anticipating 2 of them to be growth, and out of the last 4, they have a 75% track record. What is nice to see, though, the most recent 3 have all been beats, very sizable in the more recent quarter of Q3, although we have to draw to your attention, over the next 4 years, they are anticipating EPS to decrease, which will in turn increase the forward P, although marginally, to 15.16. Now, our intrinsic value at $112 isn't far off Wall Street's forecast at $110 and isn't also off the current trading price. So in reality, we see this as well as Wall Street right now trading around its fair value. But for those that are interested, at a 10% MOS, it would be a buy around $100, at 20% around $90, and at 30 around $78.79. As always though, do give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below. Grab those spreadsheets, come and join us as well in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.